Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Nevruzi and Joann Spadigam. As usual, not always, but going to start with the US because I think this week we've been in a bit of a holding pattern. I feel like every day on the morning call this week I've said, oh, we're just waiting for US inflation on Thursday, and we're finally here on Thursday, and we've had US inflation. It perhaps wasn't the market moving event that we were all hoping that it might be. Jan, do you want to talk us through what your key takeaways are from that report?
Yeah, gladly. And like we were discussing even before the call, the market reaction was almost a little bit puzzling because on the headline, which headline CPI, which includes energy and food prices and the rest of the components as well, that came a little bit stronger than consensus at 0.3% month on month, largely because energy prices had increased in the reading, while most forecasters expected it to be kind of close to flat. But the core CPI was kind of bang on consensus at 0.3. It was a true 0.3, even if you look at the unrounded numbers. Of course, year-on-year readings continue to come down because this time last year, so we're talking about the December 2022 readings, and around that period, inflation was actually increasing at a pretty solid pace. So when you calculate year-on-year returns, of course, you have to start dropping some of these numbers that fall out of a 12-month period. So the year-on-year figures will come down purely as a matter of base effects falling off. So overall, it doesn't really change the bigger picture that much. It wasn't too different than consensus. As a lot of listeners will know, the Fed and generally the economics community tends to overlook the energy and food part on a monthly basis, given how exogenous those shocks can be and how volatile those components are. So core was kind of what we expected, a little bit. Actually, I should say a little bit firmer, right? And just looking into the index and what caused the firmness versus the softness. Some of the, I guess, like the good news, I should say, core goods again flattened a month. We've been seeing kind of deflationary impulse from that side, not disinflation, deflationary from core goods. But this month it was flat, which pre-pandemic the trend was for disinflation to come from the goods side. So we're still on track. However, used car prices increased 0.5% month on month. We expected them to show a slight decline, so that was a little bit of a surprise for us. And when I say surprise, we forecast all these components from third-party alternative data vendors, things that regress well against these. For example, used car prices historically well. There's a lot of data sources that can go into it. So that was a little bit surprising. You had an increase in things like travel components, so insurance, travel-related components, medical services boosted CPI. So that was the source of strength. But I should stress things like airfares are extremely volatile month-on-month basis. Yes, they display a trend over like a 3 to 6 month period, but on a monthly basis, those tend to be pretty volatile. On the flip side, some of the good news were that we had things like rents coming down, right? So that was a pretty welcome development, given they had been stagnating for the last couple of months, and we know from new tenants indices or data providers like Zillow in the U.S. and other third-party vendors that rents are in fact closer to 0% over the last year, as opposed to like the 6% implied from the CPI. So we expect that to kind of be reflected in the official index with a lag, and it's going that direction. I'm not going to kind of start slicing and dicing too much, but those kind of fell to 0.4 a month. The rent measures fell to 0.4 on a monthly basis. So it's a welcome development. And the index, when you sum all those things up, it was like 0.3. So does it change too much the picture? Not really. It's for the Fed, it's probably the same path onward. We still think March is a little too soon for rate cuts, but the pricing for that contract didn't really change all that materially. We still have to see how this impacts the Fed's preferred inflation measure, the PCE index, personal consumption expenditures. And we think it will be slightly lower given how CPI tends to transfer into PCE, but we have to see the PPI numbers, which I don't have yet at the time of recording. So once we get those, we'll get a more complete information. But the strength, not a lot of strength in CPI is going to transfer there. So overall, pretty neutral. And to our conversation of why the market was doing what it was doing, I think when you kind of going back to digging down within the components, you had a lot of these kind of more volatile components showing a monthly increase: the used cars, the airfares, which added strength. And I think most people probably expect that to not be a permanent fixture. So again, we've managed to find something to look past, and in like the strength in inflation, and markets are kind of behaving in a benign way, I guess.
I know we discussed this a little bit last week following the Fed minutes, which kind of brought about, hinting. Went back to that old, like, thinking about slowing the pace of quantitative tightening. And we've had a couple of other Fed presidents kind of weigh in on that over the last week or so. What's your updated view on what the likely path of an end QT might look like?
So over the weekend, we had Dallas Fed's Lori Logan, who used to be the manager of the Fed's summer portfolio at the New York Fed previously. She pretty much gave a speech saying the main takeaway from the speech was that repeating what was in the minutes, that we have to start paying attention to the factors that would lead to an eventual tapering of QT. We have to be kind of cautious, and we might even have to lower the pace of monthly rundown so we can stretch the program a little bit longer. But what markets took away from that was the same message, that the Fed's kind of gearing up to now they're officially trying to figure out when the end of this balance sheet rundown process would be. As I mentioned last week, we still expect it to be June, and markets kind of price that to swap spreads widened, so treasuries doing better. You had things like market can price in the form of balance sheet pressures in the form of different money market spreads in forward space. Those are kind of showing some loosening of forward balance sheet expectations. So we were moving that direction as we thought we would. But come this week on Wednesday, New York Fed's John Williams gave a speech, not entirely contradicting, but saying, listen, we're not even close to ending QT. We still have some ways to go. There's still money in the RRP facility. So it's, like I said, it's not exactly contradicting, but at the same time, it's slightly conflicting. I think it's just more of a pushback against some views that people were mentioning, some views that QT might end as soon as March. We never thought that was the case. We still don't think him saying they're not even, close to ending QT. No one really insinuated that in our view. June is still far away out, and they have to pay attention to things like what's going on in money markets, not just the RRP facility. There's clearly a little bit of pressure brewing, but nothing too crazy. So June is still still our base case for when we would start seeing balance sheet wind down. And at the same time, I do want to kind of contrast between the two speakers, right? John Williams, of course, is the New York Fed's president, is a very well-established economist, but at the same time, Lori Logan, she has been in the weeds with this stuff, right? Like managing the summer portfolio on a daily basis. A lot of her job was just making sure that the plumbing of the system is also behaving well from her seat at the New York Fed. So I think she has a little bit more of a kind of hands-on approach in the past. They've seen how this thing went down in 2019, and maybe they're seeing similar signs that they did back then too. Nothing groundbreaking, just there's a little bit of a internal drama within the Fed. Some people are saying maybe it's time to look at when to end. Some people are saying no, not even close. We think June. So in the coming weeks, I'm sure we'll get a couple more updates. Let's get through the January Fed meeting first. But I'll switch to the UK, as next week we're gearing for a week with a decent amount of data, some key releases. And do you think they're going to matter for markets and for the BOE, Imogen?
Yeah, I think in some ways it's been a little bit of a boring start for the year in the UK. I mean, obviously there's been plenty of supply. There's been plenty of supply everywhere. But we haven't really had much to go on in terms of the kind of macro backdrop. We haven't had a huge amount of data. We really haven't heard from many central bank speakers at all. I'll come back to that, I think. But yeah, like you say, next week we'll change that. It's kind of the key data week of the month. We'll get inflation and labour market data, and retail sales as well. But I think those first two are probably perhaps more important from a market's perspective. We're expecting both of them to come off. If you remember, back in middle of December, we got the inflation print for November, which surprised to the downside quite significantly. We now have, headline CPI trending very much in the right direction towards the Bank of England's target. We think it gets there by kind of early to middle of 2024. And we think that this week, or next week rather, depending when you're listening to this, headline will print at 3.6%. Core will still be slightly higher, but probably sub 5%. And we have wage inflation, which I think will be the most watched indicator within the labour market statistics. I mean, obviously, there's a huge amount of uncertainty around the ONS data at the moment. But we expect average weekly earnings, the headline measure, to fall by about 0.5 percentage point as well. So all in a data set that I think the BOE will like, and certainly help support the market's narrative of the last couple of months that, rate cuts are definitely the next move, and that they could come, potentially soon-ish, I suppose. For the market, I think today's reaction to US CPI is quite telling. We haven't really managed to sustain much of a sell-off and find the kind of beat to consensus the number wasn't necessarily particularly strong or beat consensus by very much. But it's giving a feel of a market that perhaps is back to wanting to kind of rally and push rates lower. And so if we get the kind of data that we're expecting, I think that could trigger a rally really across the curve in the UK. For the Bank of England, how much does this data matter? Well, it's difficult to know how the bank's kind of rhetoric has changed over the last month or so, because we really haven't heard anything from them. There's been no speakers on the calendar from a monetary policy perspective, essentially, since before we had that downside surprise on the inflation data. We did hear from Governor Bailey this week, and Sarah Breeden. They were in front of the Treasury Select Committee, but in their capacity as as their responsibility for financial stability rather than monetary policy. Of course, that didn't stop them commenting on monetary policy as well, but what we did hear, I don't think, was particularly different from Bailey. He talked about the need to be vigilant against the risks to, second round risks to inflation. He also talked quite tellingly, I think, around the potential impact that the current shipping disruptions might have on inflation and monetary policy. And that's important, especially for the BOE, when we consider that most of the downside surprises that we've had in inflation so far have been about goods inflation. And so if we start to see that tick back up again at the same time while service price inflation is still high, then clearly you get a less favourable trajectory than the one that we seem to be on right now. But for the Bank of England, the reason why I say I don't know that next week's data necessarily changes all that much is because for me, they've been most concerned in recent weeks, not about what kind of spot data is telling us, but still about the way in which they see the risks skewed, and still about the risks that they see around the labour market. And I think until we get through kind of Q1 and the early year wage setting processes, the Bank of England won't be comfortable signalling that rate cuts could be coming anytime particularly soon. If you think back to this time last year, it was at this point that we had all the big upside surprises on the wage inflation data, and that will still be looming large, I think, in the minds of the policymakers. And that's really why we see them retaining this kind of hawkish narrative, even as the data turns. Now, of course, 2 or 3 months in a row of very favourable inflation data makes it increasingly difficult for them to be as hawkish as they were being in, say, early November. But I don't think that they drop that narrative particularly quickly, even if we do get headline inflation next week at around 3.6% as we're expecting.
And not only in the US, I'm going to switch gears a little bit, but in the UK, it's also an election year. And conversations around elections have been have been ramping up. So what's new on that front? What are the developments that we've been hearing?
Yeah, or at least we think it will be an election year. Most likely it will be. They have to hold the election by January 2025, but all I think it's relatively strong consensus now that it will be held in the second half of 2024. So we've got a long 9 months of discussing the ins and outs of all the different policies and plans. Somewhat differently, I guess, to the conclusion that we would probably come to if we were discussing the US election. I think from a market's perspective, although, a lot can change in 9 months, as we know, and there will clearly be volatility around different headlines and different policy announcements, etc. Actually, from a market's perspective, I don't expect the election outcome to move the needle all that much. And really what I'm thinking about that from is a kind of fiscal policy perspective. And partly that's because I think, at the moment, the polls have quite a clear front runner. And so, it's not like in the US where there's a lot of uncertainty over the next 10, 11 months, and it's not necessarily all that clear what the outcome is going to be. It feels a bit different in the UK. The polls are quite telling. There's a large gap, but also because when we think about the fiscal room available, there really is very little headroom for any government to spend especially more or raise particularly more money on the bond market. We already have a Conservative government that really have spent more than you would usually consider for a Conservative government. And we have a Labour government that is, at the moment, suggesting that they too will abide by the fiscal rules of having debt to GDP falling by the fifth year, which means that they've already had to water down some of their spending commitments. This 28 billion investment plan has already been scaled back slightly in terms of becoming a phased-in plan by the end of the term, etc. And all of this is because the lasting impact of the Truss legacy is to kind of shore up fiscal orthodoxy, we think, across the political spectrum. And both sides of that political spectrum learn where the red line is when it comes to the fiscal spending that markets will allow. And that means that whoever is in power following the election will have very little fiscal headroom to play with. We're already in a kind of major regime shift when it comes to the supply outlook. And that won't change, really, I don't think, whatever the outcome of the election is. So there'll clearly be a lot more, back and forth in the press over the next 7, 8, 9 months, however long it takes before we have this election. But really, I think, from a fiscal impact and from a supply perspective, it doesn't do all that much to move the needle. But like I say, I'm sure that that's a topic that we will return to many times over the next, best part of a year, both here and in the US, of course, as well. So perhaps with that, we can move over to Europe this week. It's been a relatively quiet week, I suppose, as well in Europe from a kind of data perspective. It's obviously been very heavy for supply, but perhaps we'll come on to that in a minute. We've been focusing in the latter part of this week as supplies quieting down a bit more on central bank speak. We've heard from people at opposite ends of the kind of hawk-dove spectrum. How do you kind of read into what we've heard this week, and what does that, or how does that change your view, or otherwise, I guess, for the timing and scope of easing in Europe, Joann?
I do think it's been a fairly interesting week in terms of ECB speakers. At least I think in terms of two things. One, the people on the committee that don't necessarily have as big an influence have made comments that have been fairly market moving. And also, I think in terms of their comments as well, we heard from doves and hawks, and I think the overall picture does seem skewed a bit more dovish at this point in time, I think, versus where we were in the past. The ECB Centino, I think, was fairly interesting. The key there really was that he did note that wage inflation data, whilst that comes out in May, we do get an early indication of what we should see in the May data earlier than May, which does suggest that these rate cuts could come early in the year, which I suppose is in line with our key view. And that's not necessarily too surprising to hear from a dove. But I think what was more interesting was that the Central Bank of Croatia's governor had not very similar thoughts, but similar thoughts as a hawk, where he did note that wage developments were important, but that actually the March forecast round, where the forecasts are likely to be moving downwards, as well as where they'd have a fairly good idea of the wage inflation data as well. He did note that the wage data was not what the ECB would be looking for in terms of a single data point to make that decision on, but actually cuts would come even before that final data point is put in. And that's actually quite dovish, I think, coming from a hawk on the committee. And I think that is really telling that this early cut story is not necessarily one that only the doves buy in the committee, but really that the hawks might be slowly coming on side. The more, I suppose, influential members, the Schnabel, did seem a bit more balanced, and Valois as well wasn't giving too much away. But I do think weighing where the doves or the less influential doves and hawks in the committee are, that really does seem to have moved towards a more dovish side versus where they were previously. So I think our expectation for early cut really is continuing to hold. We don't necessarily think that March will be the day that it happens, but I do think that we think it's a first point where it could become a possibility. So our kind of March, April likelihood is fairly balanced, but I do think that the early cut narrative is becoming more and more common within the committee itself.
Luckily, it won't be all that long before we see how that early cut narrative does or doesn't play out. I mentioned it before as well, but clearly the other main focus of this week has been supply. We've had plenty of it. I think, I'm sure someone's going to fact check me now, but I think I'm right in saying that Wednesday was the biggest supply day for European paper on record. Although we've had some concessions in terms of the move in outright yields, it feels like that supply across the board has been relatively well absorbed. What are your kind of takeaways from this week?
So, like you said, it's really been a standout week in terms of supply, beating lots of past numbers. I think we've basically seen a doubling in supply this week versus last week. And I think, at the early part of the week, when there wasn't too much going on besides supply, we did see rates being long end rates weighing a bit on the back of supply. But it does seem to me that it is being absorbed fairly well. In fact, I think the kind of mild sell-off we saw at the start of the week was fairly muted given how much supply we've seen relative to previous weeks. And so I do think that the market does seem fairly well positioned and poised to take in the supply at this stage. It does seem, like you said, that the market, again, is very much looking forward to the rate cutting narrative and trying to front load that to some extent, perhaps creating demand there in that element. So to me, even though I think supply for this year continues to be heavy, it does seem like the weight of supply will be, at least for now, less heavy, or will impact markets less, given where markets are thinking about in terms of rate cuts and really positioning for the end of the cycle at this stage of the year. So yeah, there's plenty more supply to come. We've revised our supply numbers. We've got an update from Spain, so we're adding 7 billion to our gross supply estimate. So I think the key picture for supply really is one that we've said many times before. There's a lot to come, but it seems like for now the demand does seem to be there, given that this is the start of the year.
Lots more supplies to come, and a theme that we will return to in future pods. But that's probably enough for this week. Thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.